Good morning. My name is Tess Cross. I'm an AVP at Monroe Capital here in Chicago, so I sit on the underwriting and the portfolio management team focused on syndicated and club transactions for middle market businesses. I'm a co-chair of the part-time programs credit club, a club that I founded along with a friend and colleague, Panmile Olioto. So I've been a member of the full-time credit club since 2021, and that's part of why I have the honor today of welcoming our keynote speaker. On Memorial Day weekend in 2021, I joined a networking event that was put on by the Booth Credit Club that was hosted by a generous Booth alumni willing to spend a Friday night on Zoom with a group of MBA candidates early on in the pandemic. And that alumni was Jerry O'Brien. Jerry is the CEO and the CIO of O'Brien Staley Partners, a firm that he founded with Warren Staley, who is the former chairman of Cargill. At the time I met Jerry, I was working with Betsy, who's in the audience here today, at the University of Chicago's investment office. I supported the private credit and the private equity teams pretty closely, and so I was already familiar with Jerry and his firm and their investment approach, and I was very intrigued by his strategy, which focuses on what he calls our unloved loans. I was fortunate enough to join O'Brien Staley Partners in the fall of 2021 as an MBA associate. So just a tip to the other students in the room, Jerry does hire MBA associates, so look out for the job postings. So Jerry has more than 25 years experience in the credit space. Prior to founding OSP, he spent 17 years at Cargill and Carvel. He started his career in credit analysis at Chemical Bank and DG Investment Bank. He graduated from the University of Michigan, and of course he earned his MBA here at the University of Chicago. So he's here today to ask us, do you get the joke? So it's my honor to introduce Jerry O'Brien.
Thanks. Thank you. Thanks very much. Well, that was very flattering. I don't know if I can live up to that billing, but thank you very much, Tess. Could I, real quick, before I get started, could I get a little bit of a show of hands? How many people are currently students? Yeah, excellent. Okay, that's what I thought I was talking to students. I kind of prepared my words. We have faculty or alumni also in the room, a little bit, and we have some institutional investors also, I think. So good. So as Tess mentioned, the title of my remarks are "Do you get the joke?" If you've ever worked on or sat on or worked near a trading floor, sometimes you'll hear this expression: "Do you get the joke?" Is he in on the joke, or he doesn't get the joke? Which kind of means, do you see the trade? And I always thought this was a really curious expression. So, why do you call it a joke? And as I kind of reflected on it, it occurred to me that, humor or wit is the ability to recognize something that's out of place and have a twist of phrase to capture a laugh. And I think trading is similar to that. And certainly trading desks are funny. They might be a little bit bawdy. You might not want to quote some of their jokes, but they're definitely funny. But I think that trading is the ability to see something out of place in the market and have a twist and immediately proper timing to deploy capital to capture a profit. And so I'm not going to do a stand-up routine. I'm not going to tell jokes. Rather, I'm going to try and help you guys have a framework so that you can get the joke. And as a good Booth alum, you'll be in on the joke because you can see how the trade works rather than not. Before we do that, though, I do run a registered investment advisor, and my compliance department makes me show you this slide. You don't actually have to read it, though. You can actually just, like you're at the car dealership, initial here, and we'll all be cool. This is for informational purposes only. You will not be allowed to invest, and the past has nothing to do with the future. So, okay. So with that obligation behind us, Tess did a very nice job of actually sharing my bona fides. So maybe I'm being a little bit redundant here, but as Tess mentioned, I did grow up in Detroit, and there were a few people from Southfield. I met them just a minute ago. And so I like to say that I grew up in the cradle of distress. And thank you. I went to the University of Michigan, and then my first job out of Michigan was at Chemical Bank, which is now known as J.P. Morgan Chase. Chemical Bank had a classic credit training program. It was a 2-3 year BA analyst program. I was fortunate enough to work for Darla Moore, who was known as the queen of dip finance back then. And then I went off to graduate school. Cargill recruited me between my first and second year here at Booth. And I was a summer associate in the value investment group that was investing in the tail end of the RTC savings and loan cleanup of distressed debt. I was there for 17 years. I could talk a long time. I loved working there, but I went from summer associate to associate, VP, MD, business unit leader, one of the founding partners of Carval Investors, and at the very end of my career, I was global head of loan portfolio investing for Carval with 52 people on 4 continents. But in 2010, Warren Staley planted a seed with me. Warren Staley is the retired chairman and CEO of Cargill, and he said, if I ever want to do anything entrepreneurial, let him know. And I circled back to him with a business plan. I said, you know, I've seen many people who are alum of Cargill successfully raise asset management firms. I think that if we focus on what we are the very best at, we could actually attract third-party capital, institutional capital, and build a firm. And that's what we did. And as Tess mentioned, you know, our sweet spot, we have 3 businesses now, but our flagship is value investing, in particular investing in U.S. commercial industrial credits that we call unloved. We call them unloved because we're from Minnesota. Other people might call them distressed. And then we also have an impact investing strategy, and we also have some 2 operating affiliates that are in mortgage servicing and also in deposit management. So that's the nature of my bona fides. But we're quite aware that we're not so well known, and so we often joke, if you've never heard of us, that proves our marketing strategy is working. And Kate Hurley, who's the director of marketing and brand management, hates it when I crack that joke. So that's our purpose here is to make sure that students know who we are, so that we actually have a crack at recruiting people to Minnesota. And but we also have another expression that is, if you know how to make money, why would you ever tell anybody? Usually people who are talking about how to make money are lying, and so. Why am I here doing this? And the answer is there's only one reason why I do this here, and it's because I love this school. And so, I am a proud alumnus of what I call GSB. I'm a card-carrying member of the Chicago booth and the GSB. I have the evidence that I used to have brown hair, and I have also the evidence of where I got most of my management training, which was at the Ida Noise Pub. You can notice right next to the sticker for the Ida Noise Pub, there's also a sticker for a towel. Any idea why anybody would need a towel? Why would anybody need a towel? It's in case somebody spills wine on you the night before a big presentation. That's an inside joke among the people who had dinner together last night, and someone spilled wine on me last night. But yes, Tess, we love you, Tess. So. No. Okay, so in addition to being a card-carrying member, I've been active with the GSB or booth for 29 years now. Summer associates, obviously Tess introduced herself, and then Hugh Cameron is here, who is a summer associate. Hugh, will you say hi and introduce yourself real quick to people?
Hi everyone, Hugh Cameron. I'm a managing director at O'Brien Staley Partners, and I'm also an alum from Booth full-time program, class of 2013. And I was a summer associate, I guess it was in 2012, working for Jerry. It's been a good time ever since.
Thanks, Hugh. Appreciate that. I've done lectures like this and written some articles. Some of the videos are actually on our website. It was really kind of the best compliment I've gotten this month, I guess, was from Javier. Where's Javier? Javier actually is your first year, right? So first year from Mexico, and he said he actually quoted me in his application that got him into Booth by watching one of these videos. So thank you. That was like, yeah, it's fantastic. And then my wife Lisa and I, we sponsor an MBA fellowship we have for about the last 15 years. Ben Kirshner told me he was going to come. Yeah, Ben, there you go. So you got Ben's photo right there. Ben is the current recipient of the O'Brien Staley Partners Fellowship. We've done it for a while. Been supportive of the school, and I was strong-armed into shaking a tin cup for the endowment for my 25th reunion. If you're in marketing or you're in consultancy, you should always have a graph that goes up and to the right. If you're in fundraising, you should always have a picture with a big check. Right? All right, so you got my background. We're gonna now get a little bit serious. And my goal today is to really teach you only one thing. And I want to teach you about attachment when you're evaluating credit. You get to choose where you want to invest on the capital stack. And you can be, senior secured, subordinated, equity warrants, DIP loans, et cetera. But it's really your choice. And the thing I really want to make sure you guys understand is that you don't have to take what people are selling. You should choose where you want to attach and avoid getting sold. I call that leading the dance rather than following. And we can really look at credit not just on this dimension, but on 3 dimensions. In addition to being up and down the capital stack, you can also look left and right side of the balance sheet. Sometimes a business is so distressed that there's nothing good on the right side of the balance sheet. Look on the left side of the balance sheet, or there's some assets that you might be able to buy. And I joke in my firm that if you're walking down the street and you see a house on fire, don't try to save the house. Can you steal a couch? Metaphorically speaking, of course. But okay. And then, so you go up and down, left and right, and then the third dimension is actually in and out of the holding company, the parent, or an operating subsidiary. So you get to choose up and down, left and right, or where in the holding company to attach. And I thought I would walk through 3 examples to try and demonstrate this. The first one, I'm sure you've noticed that there's been an awful lot of vacant real estate, office properties. The COVID, the return to office work has been a little bit slow getting started. Some of the statistics are showing, the physical occupancy is below 50, maybe it's just getting a little bit above 50. Of course, that's Tuesday, Wednesday, Thursday, not counting Monday and Friday. And so, the consequence of that, our view is that your contractual occupancies are going to follow your physical occupancies. They're going to converge, and they're not going to return to the same level that they used to be at. So what do you do about that? Well, you need to be extremely selective. And Alyssa Cheatham and I were in Washington, D.C. recently when coincidentally one of our contacts in a regulated business, an insurance company, called us up and said, hey, we've got 4 credits all on K Street in Washington, D.C. And we could have our choice of these 4. And it was really interesting because we were already in DC seeing LPs and other things. And I said, let's just go and do quick screening. And so the first property I think was 1400 K Street. And when we got there, we went in the front door. There was no guard at the desk. So we went all the way up to the top and we walked all the way down and we physically inspected. And yeah, it was about 25% physically occupied. And they said, no, I'm not interested in this one. And in the ground floor, it had like a Potbelly sandwich shop and an Oban Pond, but both of them were vacant because no one's upstairs, so then they lost the downstairs. And you get this vicious cycle where people are not renting upstairs because there's no amenities, and there's no amenities downstairs because there's nobody upstairs. So we said, nope, not interested in this one. So then we went, a little further down K Street to the second one. I don't remember the street number. Exact same situation. Ground floor vacant, no guard at the desk, went up, came down. It's looking like 35% occupied. And then we went to the third one. There was a guard at the desk, so we couldn't get upstairs, but it looked similar. And then we got to the fourth one, and it was, if people know the Washington, D.C. area, K Street, as you're heading west, goes under a viaduct, and you pop up inside of Georgetown. And somebody went to Georgetown. Who was it? Yeah, you went to Georgetown. Yeah, somebody else. We had dinner with somebody who went to Georgetown. But anyway, on the left-hand side, just under the viaduct, left-hand side, right next to the Swedish Embassy, is this beautiful Class A building. And the restaurants and the cafes are open, and there's people milling around. And so we decided, yeah, let's lean into this one. So we love this particular property, which is 2900K, because of its dynamics, its location, its dynamics, its quality. But we particularly loved our attachment price because it has a capital stack that is 82 million, but we were actually able to attach. It has a ground lease, and so there's a debt to the ground lease, and so we were able to attach very favorably with a 68% lien to value given this capital structure, having 37 million subordinated to us, and it's paying as agreed. there's 37 million of investors who want to make sure they don't lose it to the ground lessor. And so this is a wonderful opportunity which has been selected and curated out of the 3 or 4 others. But again, attaching at the top of the capital stack, a little structurally complex because of the ground lease, makes this a delightful investment. I'll give you another example, and we've been extremely active in Puerto Rico. Puerto Rico, most recently, it's had earthquakes, a couple hurricanes, but even before that, it had financial crisis. They had about $72 billion of distressed debt on the right side of the balance sheet, and people were speculating on it. But we thought it was really, really hard to decide, does it have $50 billion or $55 billion of unfunded pension? Well, that makes a big difference in your valuation, right? And so we just said, nah, we're not going to do any Puerto Rico. But what's going on the left side of the balance sheet? What kind of assets does this house have that we might be able to buy? And Hugh Cameron actually led this transaction for it. Will you tell people what we did in Puerto Rico?
Sure. We did 5 trades with there's a state-owned development bank called the Economic Development Bank of Puerto Rico. We did 5 trades with them, investing $70 million. We bought $140 million of paper from them, performing commercial and industrial loans, exactly what our shtick is, at 50 cents on the dollar.
Perfect. And ever hear the expression sovereign ceiling? Sometimes people say, hey, there's no credit inside of a country that is less risky than the sovereign credit itself. And we find that people tend to apply that to Puerto Rico also, but we disagree. We think there are a lot of corporate credits in Puerto Rico that are less risky than the sovereign credit. And at this point in time, when we were doing these investments, the sovereign credit was trading, the Puerto Rican GO was trading at about 13.2 return. Well, there were plenty of going concern, unrelated businesses that were less risky than that, and we were able to really capitalize on that side of the balance sheet. There's plenty of opportunities in municipal finance because it seems that almost every city and every state have a recurring budget deficit. And when markets ebb and flow, when they can no longer issue bonds, then they try to raise taxes. And when they can't raise taxes, they're kind of stuck, right? They have to sell assets. And so that's where we're always looking for an opportunity in that space to find unloved commercial industrial credits, economic development loans that government wants to divest. So that's kind of one of our secret sauces. Okay, I'm going to go to the third example, and this one is of the holding company versus the subsidiary. And we're going to do it out of our impact investing strategy. And I know I'm at Booth, and I know there's a lot of doubting Thomases in the room. Believe me, I've got an impact investment that makes a lot of sense. So this one is called District CT, and it is located just outside of New Haven, real close to Yale. And just last week, we were in Connecticut, and Alyssa, will you tell people what you saw, what we saw when we were there?
Yeah. Good morning. My name is Alyssa Cheatham, and I'm a managing director at OSP, and I lead investor relations. So as Jerry was saying, and actually, well, I do have a Chicago connection. I was not a Booth student, but I was an undergrad. So I spent 4 years in Hyde Park and graduated in '99. So Jerry was saying we were in New Haven last week and got to see a site visit for District CT, or District. And it's really neat. So it's an old bus depot that had been renovated using New Markets tax credits funding. And what it's become is partially the state of Connecticut has an innovation lab there. And then it's what I would call a WeWork on steroids. So it is a communal office space that there's actually a waiting list for folks to get in, but it's all small businesses, entrepreneurial endeavors, and it is packed to the gills. They have an area with legal support for all of the firms that are working there. It was just so refreshing to see people actually working together in person. So it was a fantastic site visit and really, I think, an impact success story. I think they've created over 300 jobs as well.
Yep, fantastic. Thanks. And I mentioned when I was giving my bona fides that I besides leading O'Brien Staley Partners in the community, I served on the board of the Minnesota and the Community Foundation. I was chair of the investment committee for a while, and it seemed like every year the topic of impact investing would come up in the boardroom and be referred over to the investment committee. And the investment committee, the boardroom, the participants are a little bit different. In the investment committee, almost everybody is an analytical MBA or a CFA or a CPA, and all of us have done portfolio optimization mathematics, and we all know to the core of our academic being that you cannot achieve superior optimized returns in large numbers over a large period of time by adding more constraints to the function. And so, we've been, apprehensive in a Chicago school of thought about investing in impact investments if you're actually trying to accomplish something with more constraints. And I fully subscribe to that. But if you reverse the question and stop telling yourself where good returns don't come from, and instead ask yourself where good returns do come from, we believe that good returns come from expertise and focus where somebody else faces a constraint. And that was the beauty of this transaction. So this transaction was in the new markets tax credit world. And there were investors, and it was really US Bank, who wanted to buy the tax credit, but they didn't want to take the senior part of the capital stack. And they didn't want any other bank to take the senior part of the capital stack. So who can take the senior part of the capital stack and be agreeable to this player, to US Bank, the tax credit buyer? And that was O'Brien Staley Partners. And so we attached at the senior, and we got very favorable terms by being able to do what was constraining for other people. In fact, we got an 8.6% yield to maturity on a 7-year interest only. And as Alyssa said, we hit the ball out of the park in terms of the impact metric of how many jobs were created with this incubator and space. So, when I say it was complex, this doesn't look like a complex. This is the actual operating company and holding company structure. We're 3 entities. We attached at the senior of the holdco and the senior of the most junior to have kind of a barbell distribution where we could control anything that should go wrong. Nothing has gone wrong, but we're definitely in a strong position. Now, I know a bunch of you, especially MBA analytic type, you saw on the screen someone claiming, what did I say, 436 bips of alpha? Is that what was up there? Did people see that? And your inner voice said, bullshit, show me, right? Yep, that's what you said. I heard it. I could hear it up here. Okay, so let me give you a yield bridge and walk you through this. You have to remember this deal is 6 years seasoned, so it's performed as agreed for 6 years. So you got to go back to the 2017 environment when the 5-year Treasury was 123, and prime rate back then was 3.25. We're in a different world, and then we had to do a 7-year IO, and so we think there were about 100 bips of yield for doing a 7-year IO. We had an indirect and a direct collateral position. We think that indirect collateral accounted for about 100 bips of yield. We had a massive intercreditor agreement with lots and lots of counterparties that you saw on the last page. So that was good for about 1.5 points. And then we have an interest rate convention at OSP, which is actual over 360, continuous compounding. Most banks are actual over actual monthly compounding. And so on a 7-year duration, you pick up the better part of 40 bips on that. And then there were some discount points amortized over 7 years. We think it's very, very important that you know where your yield's coming from, or you don't understand your trade, you don't know what you're doing. And I think this is a differentiator of OSP in the impact space versus some maybe crossover players who are doing things like we're doing, but without the full awareness of the credit and the capital structure and that kind of stuff. So there's our third example. If we're okay on time, I thought I would spend a minute or two giving a little bit of alumni advice on if I were you, if I were coming out of school right now or going into school or in the middle of school, where would I want to invest my career, my time, and my talent? The Chicago School of Thought starts with the if markets are efficient, then nothing matters. You can just throw darts and it's indifferent. But the key to that, I think people miss it all the time, is the word if. If markets are efficient, then it doesn't matter. Well, guess what? Find an inefficient market, right? That should be your objective. Where can I find an inefficient market? And get in front of the wave. Don't try to chase and catch a wave. If you're reading about it in the Wall Street Journal, you're a little late, right? So here are some ideas to maybe put in your mind and say, well, could I actually do that? So reorg equity investing. Wow, total orphaned asset. Most reorg equity that comes out of the restructuring in a bankruptcy, you take back, someone's in the senior secured or the fulcrum security, and they get back some debt and they get some equity. Well, that equity is now sitting in a fixed income portfolio. Those guys don't want that equity, and it's not yet listed, and they just want it to go away. So if you were to build a business and a practice and expertise in reorg equity, there are no natural holders of that. So I encourage you to think about reorg equity. Muni finance, we talked a little bit about muni finance earlier. Muni finance, I don't think there's any courses at Booth in municipal finance. I don't remember any. And I don't think anybody's sitting at Ida Noyes or wherever you guys hang out now, not down in Hyde Park. I don't think anybody's saying, you know what, I'm going to go into muni finance. That's not very sexy for a Booth alum. But I got to tell you, if you look at distressed revenue bonds, that's a commercial industrial credit, and there's nobody in that space. Well, there's probably 6 members of the fraternity, so you can definitely make a mark in distressed muni revenue bonds. MSRs, mortgage servicing rights, and you can play this. There's great courses at Booth in analytic finance, the fixed income mathematics courses, stuff like that. When interest rates go up, when interest rates go down, mortgage servicing rates go down because everybody prepays and disappears. But what's going on right now? Rates are going up, and mortgage servicing rates are going up. And so, this would be a really interesting opportunity as the rates are moving. How do you play rising rates? MSRs. They move the same direction. And you can do that either synthetically in the structured credit, or you can do it in operating plays. Banks with mortgage servicing rights, or we have a wonderful subsidiary, Marinat, that has about $10 billion of mortgage servicing rights. Commercial real estate, credit and workouts. It's kind of a crowded space. A lot of people do commercial real estate. So I don't want to say that this is an unrecognized opportunity. But most of the people in commercial real estate are actually fee-simple equity investors with a growth mindset. It's a narrower subset of people who attach at the senior secured and the unloved credit and negotiate against those players. So, if that's your penchant, there's an opportunity there, but it is a little bit more crowded space with crossover investors. And then finally, impact investing. It's kind of the rage. I would say that 50% of the applications we get these days are people interested in impact investing. But people who do impact investing with the discipline of credit is a narrow set. So you could actually be a very competitive, disciplined credit investor in impact investing. And stay on the top of the capital stack. Let the nonprofits and the NGOs bear all the real risk, and go and capture 400 basis points of alpha off the top of the capital stack, rather than feeling like you have to have a 20% return with a Sharpe ratio that's incalculable. Take your 400 bips and go home. But most importantly, I think, find some joy in your life, right? And what we do at O'Brien Staley Partners up in Minnesota is we say we're going to do what we want, where we want, with whom we want. And for us, what we want to do is unloved credits, and where we want is based in Minnesota. We do it nationally, but we're up there. And with whom? Well, we like to work with people like are in this room. Smart, intelligent, happy people. So that's it. So I'm a proud alum of Booth. Getting used to saying Booth instead of GSB. And if anybody had any questions, I'd be happy to field them. Yeah.
I was curious how you feel about investing in Puerto Rico-based credits today.
Yeah.
On one level, very on-trend, surging demand in leisure travel. On the other hand, they do seem to get it more regular basis.
Okay, so I got a rival picking my brain here. So it's fair. It's a fair question. and a very good rival with great partners that I know and love. So we've been investing in Puerto Rico, and I'm using the collective we, O'Brien Staley Partners, back 17 years into Cargill and Carval. We've been investing in Puerto Rico since 1999. And we've identified some permanent inefficiencies that we love. The first thing about Puerto Rico is people misperceive it to be Latin America. They think it's like investing in the Dominican Republic or in Mexico. It's Spanish language, but it's US dollar and US courts. And most of the credit agreements are in English. So we find that we're able to capture, call it a LATAM premium without actually getting a LATAM risk. I think people underestimate the risks of investing in Mexico and overestimate the risks of investing in Puerto Rico. We've also found that because we're from Minnesota, there's a principle of law. It's called diversity. If you're from Colorado and I'm from Minnesota, and we have a dispute in excess of $250,000, we don't have to use your court or my court. We can use the federal court. And so in Puerto Rico, if you have a dispute, the best thing you can do in our experience is get docketed on the federal court, and then rational negotiations towards settlement and sue. If you're docketed on the local court, that's an indeterminable timeline, and rational negotiations will not follow. Right? It'll be prolonged negotiations until you can suffer through that court. So we have been bullish on our ability to source and execute and make superior returns in Puerto Rico. We're not entirely, we have some leisure and hospitality investments there. We've got a really nice investment in Puerto Rican dairies. Who knew there were dairies in Puerto Rico, right? I mean, it's like, but if you want to have milk in the middle of the Atlantic, you're going to have cows there. You can't put a tanker load full of milk to go there. So we've done that. We've done tugboats, and we've done all sorts of small businesses and car washes and hotels and stuff. So we continue to be bullish about Puerto Rico. Thanks for asking. Yep. Yeah.
I'm a lawyer, not a business person. I was intrigued by you attributed some portion of the yield to the intercreditor agreement. I
Yeah.
dropped intercreditor agreements. I've never heard anybody actually attribute a yield. I just didn't understand the concept
Yep.
you were getting.
So I believe that the density and complexity of the intercreditor agreement drives away competition. And so, would other people make that loan if it was as simple as the first page rather than the second page? Well, it was as simple as the first page, yeah. And then you get this 54-page intercreditor agreement with obligations that you have to the guy down the capital stack, and standstill agreements, and wait to initiate default or foreclosure, and hey, if whatever. All that complexity. So
How do you quantify that?
well, so in that yield bridge, it was actually the plug figure of everything else. So we knew what we were achieving, and we estimated 100 bips for IO, 100 bips, and we said, okay, what else is left? That's the intercreditor agreement. So yeah. So yeah, you caught me. You caught me in a sneaky math, but it made it all work to the basis point. Yeah. Yeah. Thank you. Okay. Oh yeah.
Can you talk a little bit more about how you find these unloved credits? What are you looking for? Any qualities that stick out to you when you're originating and looking around?
Yep. So we that's a whole nother speech, and it's on our website, and you can go right there and see it. But and if you're interested in the fellowship, it's over there. So we source both directly and indirectly from banks, insurance companies, regulators, and then indirectly from a cottage industry of boutique investment banks. People call them loan sale advisors. And so the first thing we do is make sure people know who we are and what we're interested in, which is unloved U.S. commercial industrial credits, $5 to $25 million transaction sizes. And then we do a lot of filtering and screening. And so we start with a defined bullseye of what we want. Unloved means that we want, in a portfolio construction, 70 to 80% of our portfolio to be cash flow positive. It might have profound covenant defaults. It might be paying under a modification or a forbearance, might be spontaneously paying past maturity, or it might be paying in bankruptcy. But there is a world of difference paying versus non-paying. And so we're trying to focus in on that. And then there are things that we don't want to do. I hate doing golf courses. To me, golf courses are always vanity plays, and they never have the cash. You might actually make money, but it's because you found someone who loves golf more than you do. And so we try to avoid that. So it's a lot of shoe leather, and that's, we've been in now, 13 years, O'Brien Staley, 17 at Cargill. So we're well connected, but we work on it all day, every day. We go to conferences in DC, we go to conferences where we can meet our counterparties, rather than going to conferences where you can meet your competition. Meeting your competition is good for your next job. It's not good for sourcing deals. So you got to find a conference where your competition isn't. So.
Thank you.
Yeah, you're welcome. Yeah, please.
Thanks for coming and talking to us. Can you talk a little bit about why you don't see the sovereign ceiling in Puerto Rico, like you see in other places? Is it due to the land discount, or is it something else?
Yeah, and this is my point of view, and people are welcome, but I believe that you can find a very well secured, cash flow positive performing business that, so the sovereign yield when we did most of those economic development deals was 13.2%. Well, there's lots of things that are not a 13.2% credit risk in a commercial taxable business. And so I believe in the case of Puerto Rico, it's because it's not Latin America. It does have US courts, it does have US currency. And so, if you take the same thing and you put it into another country where you don't have a reliable rule of law that lasts more than 18 months, and I'm talking about Argentina, then you have your sovereign ceiling. So, I like to just close by thanking, everybody for inviting me, Tess and Liz and Flo. This is great. I'm a very, very proud alum. You can see, if you want more information, you can see how to contact us and snap a picture if you want to see Tess's video on there or anybody else's video. And appreciate it. We're going to stay for most of the day, stay here for lunch, and stay for happy hour possibly. Depends on the weather in Minnesota. But thank you very, very much. Appreciate it.